Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. We know that the Chinese tech stocks such as Alibaba have been brutally hammered over the last 1 to 2 years with almost no major tailwinds or catalyst boosting the share prices. One of the biggest risks facing these companies is the risk of delisting from US exchanges by 2024. But earlier this week, there was a big announcement that the US SEC and China's CSRC, bodies that oversee stock and securities in both countries, have reached a deal to allow US auditors to review Chinese companies' books. This is a huge news, at least on paper, but we did not see the major uptick in the Chinese stocks. In this video, let's take a deeper look at what's happening and why we might not see the upside so soon. Before we start, please smash the like button so others can find this video as well, and do subscribe to get more updates on Chinese tech stocks such as Alibaba, Tencent and Baidu. Let's dive in. PCAOB, which is Public Company Accounting and Oversight Board, inspects and investigates registered public accounting firms in more than 50 countries around the world. But for more than a decade, the PCAOB's access to inspect and investigate registered public accounting companies in mainland China and Hong Kong has been obstructed. In 2020, US Congress passed the Holding Foreign Companies Accountable Act under the HFCA, beginning with 2021, after 3 consecutive years of PCAOB determinations that authorities in the People's Republic of China obstructed its ability to inspect and investigate these accounting firms. The companies audited by these firms would be subject to trading prohibition on US markets. Such a trading prohibition would be carried out by the SEC. In 2021, the PCAOB made determinations that Chinese authorities prevented it from inspecting and investigating mainland China and Hong Kong firms completely, so the clock already started ticking. Due to the possible delisting risk, many investors have either fully pulled out of these Chinese tech stocks or have converted their holdings to Hong Kong exchange. Last week, both SEC and CSRC announced that they have reached an initial agreement. SEC shared on its website that today, the Public Company Accounting Oversight Board signed a statement of protocol with China's CSRC and Ministry of Finance governing inspections and investigations of audit firms based in China and Hong Kong. This agreement marks the first time we have received such detailed and specific commitments from China that they would allow PCAOB inspections and investigations meeting US standards. It further stated that, make no mistake though, the proof will be in the pudding. While important, this framework is merely a step in the process. This agreement will be meaningful only if PCAOB actually can inspect and investigate completely audit firms in China. If it cannot, roughly 200 China-based stocks will face prohibitions on trading of their securities in the US if they continue to use those audit firms. CSRC on its portal also confirmed this and shared that the US-China Audit Oversight Cooperation Agreement is an important first step by both sides to resolve issues. The agreement establishes a framework for regulators from both countries to carry out cooperation in inspecting and investigating audit firms within their jurisdiction in accordance with applicable laws. So things are looking promising, but it's important to note that this is only an agreement as of now. Until the first investigations are completed successfully, we don't fully know whether this agreement will be sufficient for PCAOB to allow Chinese firms to stay listed, especially because the agreement is based on the same deal signed between the two superpowers in 2013. That deal turned out to be too good to be true. When US officials arrived in China, they were stonewalled by regulators and couldn't access the audit books. This time around, auditors will transfer companies' financial working papers to Hong Kong due to China's strict protocols where US officials will inspect them. China has already contacted the country's auditing firms dominated by the Chinese arms of the Big Four, PwC, Deloitte, KPMG, and Ernst & Young, and told them that they can hand over the necessary documents. So even though CSRC announced that both sides have found a feasible path for the US to carry out audit inspections while maintaining China's national security over sensitive data, but China has a sprawling bureaucracy and a huge number of authorities could intervene to stop some data being handed over. Plus, a discrepancy in the language each side used reveals a clash in the understanding of how involved the Chinese authorities will actually be in the inspections. This adds yet more uncertainty to the next few months of work by the US and China in Hong Kong. Big Four auditors are also waiting with bated breath to see how the deal pans out. The firms have faced an increase in regulatory fines and shareholder lawsuits over their work in Europe and the US. Opening up their Chinese audits to US regulators could increase the chances of potential liability even further for them. The stakes involved in making sure this goes smoothly are very high. So overall, it is a big news, but the next few months till December are really critical to see whether the Chinese company's delisting risk really gets mitigated or not. Alright, that's it from us for now. Hope you enjoyed this update. Please smash that like button and be sure to subscribe to get the updates on Chinese tech firms. Thanks for watching.